So, U.S. taxation of limited partnerships. So as I talked about right at the end there, partnerships are flow-throughs. So they flow right down to you on your return here. The benefit to that is that you don't have a double layer of taxation like you would with a C corporation in the U.S. So when you set up a limited partnership in the States, you can figure on you're going to have to pay tax in the U.S. and then you get a corresponding tax credit in Canada, and you'll take that income or take that money into income here in Canada, regardless if the money is distributed to you or not, as we discussed earlier. So you still have to pay taxes on it. Now, when it comes to holding rental property, what you need to be aware of is this 30% U.S. withholding on gross rental income. And I have an LLP up there. It doesn't matter. It just applies across the board. If you owned it individually, if you owned it through an LP, LLP, LLLP, they're going to withhold 30%. Now, the person who is managing your property is required to withhold that 30%, or they're liable. If you do not have a property manager, then your tenant is actually required by the federal government to withhold 30% of the gross rents that are payable to you. And those have to be turned over. What?
How does that differ from the C corporation tax bracket?
Well, we're coming to that. We're coming to that. How does this differ? This is just a flat 30% withholding on all gross rents. It has nothing to do with this, with the C corporation's tax bracket. The IRS is concerned that you'll take that money out of the country and not pay U.S. income taxes on it. So what they'll do is they'll just apply this flat withholding on all of your income, just to ensure that they get their share. Now, you can get it back by filing a U.S. tax return, but if you don't, they're just going to keep 30% of your rents on a monthly basis. And they get turned over to the service. Now, if you adopt this route, which is all you're doing is owning property, you're not making any filings in the U.S., then you're also not entitled to any deductions. With real estate, you're allowed to depreciate it. So when you depreciate your real estate, it offsets your income that you bring in from your rents. So that's a benefit of owning property. You can depreciate the property and reduce your taxable income. So you're putting cash in your pocket that you're not paying taxes on because of the depreciation. Now, when you sell that property in the U.S., we recapture that depreciation. So you have to recapture it at a flat 25% rate, flat 25% taxes on your depreciation. You do not have an option here. This is mandatory when it comes to owning U.S. real estate. You are forced to take depreciation. Now, what can be particularly painful to you is that if you do not do anything, as far as the U.S. is concerned, that means you do not obtain an individual taxpayer identification number. You need an ITIN, which is required by filing a W-7 form with the IRS. If you don't do anything, you're not allowed your depreciation deductions. Then when you sell the property, you're forced to recapture that depreciation as if you had been deducting it all along. So you get hit with this added tax penalty. And you can't take any deductions otherwise for management fees or nothing against your income. So it's really draconian the way they treat individuals who do not apply for an individual taxpayer identification number if you're going to invest in the U.S. Now, in addition to applying for an individual taxpayer identification number, you have to basically treat your rental income as effectively connected with the U.S. trade or business. And the way you do this is you file a 1040 NR each year, non-resident 1040. Now, as an individual Canadian, what you'll do, the way it works, we set people up, we fill out their W-7, they get their individual taxpayer identification number. Once they have their individual taxpayer identification number, then we obtain an EIN number for their limited liability partnership. So you have to have two taxpayer identification numbers if you're investing through a limited partnership. So you can't bypass one. If you try to bypass the individual number, you won't be able to get the 1065, the EIN for your entity. And if you yourself are not filing a 1040 each year, then your partnership will be required to withhold the 30% out of your income. So one way or another, they're going to get their payment, the IRS is. So the way you solve all these problems is you elect to file a U.S. tax return. If you elect to file a U.S. tax return, you can take all your deductions against your income, you can depreciate your property as well, and you won't get burned when you sell it. So when we invest down there, again, the steps are to file a W-7 to get your ITIN, and then we go and obtain an EIN, which is the taxpayer identification number for your limited partnership. And then we've opted out of this 30% withholding. And again, people invest in the U.S. and it's not a problem. If they don't do this, a lot of times it'll fly under the radar, but when you sell the property, that's when they're going to catch you, is when you go to sell the property. Or if it's encumbered, you'll get caught typically on the loans if you try to refinance a property. There's a number of ways the IRS can catch people now. Now, impact on Canadian owned an interest in a partnership. There's a flat 35% U.S. withholding on gross proceeds by partnership, or 10% if individual seller. So if you're selling property, when you go to sell it, there's a flat tax that will apply. So if an individual owned property in their own name, the IRS is going to withhold 10% of the gross proceeds. When I say the IRS, it's actually going to be the purchaser of the property who's buying the property, or escrow. If it's going through escrow, they're required to withhold 10% of the gross proceeds if the seller is not a U.S. citizen. So they'll withhold that. Now, if it's sold through a partnership, then they're going to withhold 35% of the proceeds when sale of a partnership. The way you avoid this withholding tax is you apply for a withholding certificate. You best give yourself 90 days. So if you think you're going to sell a piece of property in the U.S. and you don't want to be subject to this tax, I mean, if your tax liability is less than what they withhold, if you file an individual income tax return, you'll definitely get it back. But the thing is, if I'm going to take those proceeds and I'm going to reinvest them in another piece of property, I don't want the government holding on to my money and I'm waiting till next year to get my income tax return filed to receive those funds back. So I'm going to think ahead and I'm going to file for or claim for a withholding certificate so that the IRS will not impound these funds. That's a possibility for you. So you have to give them at least 90 days. And you can obtain that, and then you won't be subject to that. Basically, what they're looking for is that you're going to pay your taxes because you've been filing returns. So that's a withholding certificate. Partnership must be current on tax returns. This is reasons where they will deny it. If you're not current on your individual returns or your partnership is not current on its tax return, they will deny your withholding certificate. Another thing that has to do with this 30% withholding, if you yourself are not current on filing your 1040 NRs, then they will deny you're effectively connected and go back, force you into the 30% withholding on all of your rental income in the U.S. Just a way to make sure that tax man's getting his due. So any questions on that? All right. So the LLCs. Basically what I was talking about earlier, in the U.S., an LLC can be taxed as a partnership, corporation, S-corporation, ignored for federal tax purposes. Regardless of how you treat the corporate or the LLC in the U.S., Canada is going to treat it the way they want to treat it. And it's not very favorable to you. So this is not to be owned by you or your Canadian corporation. The only time you'll set up an LLC is in the situation that I provided before lunch, and that is where you will have a limited liability partnership or triple LP that will own LLCs. You yourself will not be directly connected to that company in any circumstance. So if it's owned through a Canadian corporation, then you do not receive what's called the branch profits tax of 5%, does not apply. There's a treaty between the U.S. and Canada that has a set tax when profits are repatriated back out of USCO back to Canada on a flat 5% basis. That branch profits tax is only going to apply to U.S. corporations that are owned by Canadian corporations. If you set up an LLC and elect to have it treated as a U.S. corporation for tax purposes, it will not apply, and your tax rate is going to be 30% in the U.S., and you're going to hit at 36% Canadian on any income you generate inside of an LLC that is held by your Canadian corporation. So you're basically putting yourself at 66% tax rate overall. It's ridiculous. Doesn't even make the investment then worth it. On the same token, if an individual owns the LLC, you're going to pay tax on any money that's generated by that LLC, because here it's a timing issue as well. That if you have an LLC set up in the States that's not distributing money, you pay tax on that money just as you would a partnership. But in the partnership setting, you receive a credit for US taxes on the Canadian side. But in an LLC that's treated as a partnership, you will not get that credit. So again, we're forced into a situation where we pay taxes in the US without obtaining a credit on the Canadian side for the taxes that we had to pay. So again, if you made $30,000 in income, you pay taxation on the US side on that $30,000 in income. And then you come over and you put that $30,000 back on your Canadian side as well, and you'll pay tax on it all over again without getting the credit for what you had to pay in the US side. So that's something why you want to avoid the LLCs. And unfortunately, you know, there's a lot of information, misinformation out there on the internet that has to do with this. In the back table on the next break, I will have a copy of a piece that I wrote that explains this in much more detail. It's on my blog site. I printed off a copy yesterday. It'll be back there, print it out for you. Go ahead and grab one if you want to get some more in-depth information on how this is all put together.